Although inflation is always a hot topic for central bankers, it's not always something that we have to worry about in the markets. However, there are certain times, like the one at the time of filming this video, where inflation is one of the major themes in the markets and any data related to it causes heavy price disruptions. During these sorts of times, there's something important that you need to understand in order to analyse the situation effectively. Not all inflation is created equally. Now, in broad terms, inflation is often categorized into three different types. We have demand pull inflation, cost push inflation, and built-in inflation. And depending on which type of inflation is being faced or could be faced, different types of data will be more or less relevant than others. So before I explain each of those types of inflation, let's first of all think about basic economics. You probably already know that inflation is measuring the rise in prices in the economy. And in economics, prices relate to the law of supply and demand. Now, without getting into too much detail about it, it's basically the case that prices change when either the supply or demand or both change. So if supply increases and demand doesn't, or demand decreases and supply doesn't, or both, prices will fall. On the other hand, if demand increases and supply doesn't, or supply decreases and demand doesn't, or both, prices will rise. Now, the reality of a situation can be a bit more nuanced than that, but just by understanding that dynamic, it will help you to understand the different types of inflation. It's basically going to be one of the options that I just went through where the prices rise. The first type of inflation is known as demand pull inflation, and as the name suggests, this is inflation that's driven mostly by the demand side of the equation. So in other words, it's when the overall demand for goods and services increases quicker than the economy's production capacity. Now, there are many reasons why this could happen, but it often relates to an increase in the money supply, which is often caused by monetary and fiscal policy. So for example, if there's been loose monetary policy, such as low interest rates, it makes borrowing less expensive and there isn't as much incentive to save your money, so there'll be more money going around the economy. Alternatively, central banks might go through quantitative easing to increase the money supply, or there might be an increase in government spending. All of these things are going to increase the money supply, and this can lead to demand pull inflation. Now, since monetary policy has an effect on demand pull inflation, it also means that central banks have the power to act against this type of inflation as well. And this can be done through tighter monetary policy, which usually involves raising interest rates. We may also see the government cutting demand by reducing spending and increasing taxes. Now, if we're looking at demand pull inflation, we'd be particularly interested in things like retail sales, consumer spending, and durable goods orders. The next type of inflation is cost push inflation. This is driven by the supply side of the equation. It's when prices rise because the total supply of goods and services falls, or the cost of production of the goods and services rises and is passed on to the end consumer. Again, this can happen for many reasons, but a common one is when the price of raw materials increases. This is especially the case when energy costs rise because energy is usually a big input cost for most goods. It could also be that there's some sort of disruption in supply chains, as we saw happening during and after the pandemic, or things like weather causing disruptions in the production of goods. Now, central banks can't usually have an immediate impact on most supply side issues, so this type of inflation can be a tricky one for them to deal with. However, if cost push inflation remains there for a while and it's persistent, the central bank may be forced to raise interest rates in the hope that it will filter through into other areas of the economy. But in fact, studies have shown that there is a longer-term negative impact on supply when a central bank takes this sort of action. Tighter monetary policy will lead to lower business investment, which ultimately affects productivity further down the line due to a lack of R&D, research and development. Now, the data we'd look at for cost push inflation will depend on the specific factors that are causing issues with supply, but in most cases, we'd be interested in looking at commodity prices, particularly energy costs and those related to food, things like soybean, grain, and so on. The third type of inflation is built-in inflation. Now, this differs from the other two types because this one often comes as a result of inflation expectations. So it's a case of inflation itself causing more inflationary pressures. The most common type is known as a wage price spiral. Since people are seeing inflation rising or expect it to rise, they then demand higher wages in line with inflation so that they don't end up taking a pay cut in real terms as inflation goes up. Now, as a result, not only do people then have more money to spend in the economy, but businesses will also have to increase their prices to make up for the higher costs, the costs that they're facing from higher wages. Alternatively, it might be that a business expects its production costs to increase due to inflation, so it raises its prices in anticipation of that. In both cases, these expectations become sort of self-fulfilling, as these increases contribute to the increase in inflation, causes it to happen. This type of inflation is pretty much a worst-case scenario, and it's often referred to as sticky inflation because it can be really persistent. In most cases, a central bank will want to take preventative action to avoid built-in inflation happening, since it can be really difficult to tackle it once it's in place. So they'll likely already be tightening their monetary policy quite aggressively to bring inflation under control. And when this happens, we can expect negative economic growth and sometimes a recession. Now, in terms of data, a key one to pay attention to for built-in inflation would be things like wage growth data and the jobs numbers in general, including job vacancies. So hopefully you can see now how different types of inflation call for different types of action, and for us in the markets, it means we should be paying attention to different types of data, some more than others in different situations. Now, to understand this data better, check out the playlist that's on screen where we go through each of the economic data releases that you see in the monthly cycle and how they impact the markets. Thanks for watching.